Most people believe Swiss banks are only for billionaires. They imagine marble lobbies, gold bars hidden in the Alps, and a stern banker shaking his head if you come with just a million. But reality is very different. I have seen accounts opened with 100,000 francs, and I have seen accounts rejected with 10 million. I have seen wealthy Americans welcomed in one bank and thrown out of another on the very same day. And this is exactly why Swiss banking is so misunderstood. Today, I will reveal to you 15 Swiss banking rules that no banker will ever say out loud. Rules that can save you hundreds of thousands in fees. Rules that decide whether you are welcomed in Switzerland or politely rejected. Rules that will determine if Swiss banking is your fortress or a waste of your time. My name is Enzo Caputo. I am a Swiss lawyer, former CEO of the Swiss Association of Asset Managers. For 35 years, I have guided clients from more than 50 countries through the jungle of private banking. I do not work for banks. I do not sell products. I am not a financial influencer chasing clicks. I protect clients. I fight hidden fees. I secure accounts when compliance departments want to say no. And I know the unspoken rules, the rules bankers discuss behind closed doors, but never share with outsiders. Rule 1. Relationships beat minimum deposits. Officially, most Swiss banks demand 500,000, sometimes even 1 million francs as the minimum ticket. But the truth, I know cases where a banker opened an account with just 100,000. Why? Because Switzerland thinks long term. A Swiss banker is not only looking at your money today, he is imagining what your account could look like in 10 or 20 years. He wants a relationship, not a transaction. If you only want to park money for 6 months, Switzerland is not for you. I remember a young entrepreneur from Eastern Europe. He sold his first company and brought 120,000 francs to Zurich. Not much by Swiss standards, but the banker saw his potential. Today, 10 years later, that same entrepreneur holds 12 million in his Swiss accounts. The bank was right to ignore the minimums, because in Switzerland, relationships matter more than deposits. Rule 2. Swiss bankers understand wealthy clients. Do you know what a Swiss private banker earns? With 5 years' experience, about 250,000 francs. With 10 years, 500,000. Managing ultra-wealthy clients, often 7 figures. This is important, because when you talk to a Swiss banker, you are not talking to a cashier. You are not talking to someone who struggles with his own rent at the end of the month. You are talking to someone who also manages investments, also owns real estate, also protects his own family wealth. They speak your language because they face the same challenges, and this creates trust. Imagine discussing investment risk with someone who earns 40,000 a year. Now imagine the same discussion with someone who himself owns $1 million portfolio. Which one will understand you better? Rule 3. Fees can ruin you. One of my clients once paid more than 400,000 US dollars per year in fees. He had 15 million deposited. The bank was charging him around 3.5% annually, far above market. Why did he accept it? Because of his passport, his residency, his profile. The bank thought he had no choice. They thought he was stuck. When he came to me, we restructured everything. We spread his assets across 3 banks. We reduced his average fee to just over 1%. That decision saved him 250,000 per year. Every year. That's a Ferrari. Every 12 months. Just in fees. One wrong bank can silently eat your wealth. One hidden fee can burn more money than any market crash. And this is why knowledge of the unspoken rules is worth millions. Rule 4. Swiss secrecy today. When people hear Swiss banking secrecy, they imagine black briefcases, hidden vaults, and anonymous numbers. That was once reality. In the 1970s and 80s, you could open a numbered account. Your name never appeared, only a code. The index card with your real identity was locked in a vault. If you didn't declare the account, no tax authority in the world could find it. But those days are over. International pressure destroyed anonymous banking. Still, Swiss banking privacy is not dead. It is alive, but in a different form. Today, your banker cannot disclose your financial data to anyone, not even to other departments inside the bank, without your permission. If he does, it is a criminal offense. He risks prison. The only exception? Taxes. Switzerland cooperates on tax matters. If you don't declare, you will be found. So the rule is clear. Swiss privacy still exists, but not for hiding taxes. Rule 5. Everything is negotiable. In your home country, banks give you a price list. Flat account fee, fixed trading commission, rigid structure. In Switzerland, it works differently. Here, almost everything is negotiable. Don't like a flat fee? They offer a percentage. Don't like advisory charges? They create a different arrangement. Don't like custody costs? They adjust. If you have the right profile, the Swiss banker will adapt the terms to fit your needs. Why? Because Switzerland does not want short-term profit. A banker prefers to lower his margin today if it means you will remain with him for the next 20 years. I once negotiated fees for a Latin American family. They came in with 5 million. The official fee schedule suggested 1.5%. After negotiations, they paid less than 0.7%. That difference saves them hundreds of thousands every year. This is why I always tell clients, in Switzerland, you don't accept the first offer, you negotiate. Rule 6. You don't need to invest. Another myth, if you open a Swiss account, you must hand all your assets to the bank for investment. False? Yes. Banks love to manage portfolios. Yes, they earn advisory fees. But some clients come only for security and diversification. They want their money in Switzerland, nothing else, and banks accept it. For a flat annual fee, you can keep your funds without active investment. Sometimes the most intelligent decision is not to chase returns, but to secure stability. I once worked with a retired athlete. He earned millions during his career, but after retirement, his biggest fear was losing it. He wanted zero risk. We placed his assets in Switzerland, cash, gold, a few safe bonds, and he slept peacefully. For him, performance was secondary. What mattered was safety. Rule 7. Switzerland is not always the best choice. Now let me surprise you. Switzerland is not for everyone. If you only need simple banking, a few foreign currencies, a basic account, easy cross-border access, then Singapore, the Channel Islands, or even some Caribbean banks can serve you well. They often demand lower deposits and charge lower fees. Switzerland is the right choice when you seek sophistication and protection. Lombard loans, gold custody, complex structuring, multi-generational wealth planning. I always say Switzerland is the Champions League of private banking. If you only want a savings account, you don't need to play here. Rule 8. Crypto wealth is possible. Many believe that if your wealth comes from crypto, no Swiss bank will touch you. They think blockchain equals black money. That's not true. Some of the most sophisticated Swiss banks now onboard clients with crypto origin wealth. But there is one condition: documentation. If you can prove where the coins came from, exchange receipts, wallet history, transaction records, the bank can accept you. Some institutions even have internal blockchain analysis teams. They don't rely on your documents. They run their own audits, verifying wallet addresses and transaction flows. Of course, not all crypto activities are welcome. Anonymous DeFi projects, gambling tokens, shady ICOs, forget it. But if you mined Bitcoin in 2015 or you sold Ethereum on regulated exchanges, Switzerland can integrate that wealth into the system. I had a young tech entrepreneur. He was nervous. Enzo, no bank will ever accept my coins. I told him, with the right documents, Switzerland will. 2 months later, his crypto was converted into Swiss francs and booked into a Zurich account. The lesson: with transparency, crypto becomes legitimate wealth, even in the most conservative banking hub of the world. Rule 9. The David case. Wrong banks, lost time. Let me tell you a true story. I'll call him David. David had a liquidity event. He sold a company and wanted to diversify part of his wealth into Switzerland. His advisor introduced him to 2 banks. He spent 6 months with the first. Compliance asked endless questions. Documents piled up until finally the bank said no. He tried a second bank. 4 more months. Same story. Another rejection. 10 months of life wasted. When David came to me, I looked at his profile. Within 30 minutes, I knew these two banks would never accept him. Wrong profile, wrong jurisdiction, wrong deposit size. If he had come earlier, he could have saved almost a year. In Swiss banking, choosing the wrong bank is worse than not choosing at all. This is why insider knowledge is priceless. The website of a bank will never tell you if you are a fit. Only insiders know which doors open and which remain locked forever. Rule 10. Transparency through mandates. People think Swiss banking is secretive, foggy, mysterious. It is not. When you open an account, you sign a mandate. This document defines everything: which currencies you hold, which investments you allow, which risks you tolerate, how often you want to be contacted, and the fees. Nothing is hidden. Nothing is left in small print. Compare this to your home bank, where contracts are 100 pages in size 9 font. In Switzerland, the mandate is clear, transparent, written in plain language. Swiss banking is not built on secrecy anymore. It is built on clarity and trust. Rule 11. Lombard loans. Liquidity without taxes. Now let me share one of Switzerland's most elegant tools. It's called the Lombard loan. Here's how it works. You deposit assets, securities, gold, even cash, and the bank lends you 70–95% of their value at low interest rates. Why is this powerful? Because you unlock liquidity without selling. You avoid triggering taxable events. Your portfolio continues to grow while you use the borrowed money. This is how wealthy clients create liquidity without losing control of their wealth. I once had a client with 20 million in securities. He needed 3 million liquidity for a real estate project. Instead of selling, we structured a Lombard loan. No tax, no disruption, no delay. He built his project, and his securities kept compounding in Switzerland. The Lombard loan is invisible to outsiders. They see you using capital, but they don't see that your assets are untouched, still compounding. It is the most discreet way to access your wealth without destroying it. Rule 12. Gold in Swiss vaults. When people think of Switzerland, they think of gold. Underground vaults, mountains, secrecy. That image is not fiction. It is reality. Swiss banks operate some of the most secure vaults in the world. You can store bars, coins, bullion in custody, legally protected. But here is the insider truth. Gold in Swiss banks is not just sleeping metal. It becomes collateral. You can pledge it for a Lombard loan and transform your immobile bars into liquid capital. In Switzerland, gold is both security and liquidity. I once advised an Italian industrialist. He had 30 kilos of gold hidden in a safe at home. He slept badly. We moved it into a Swiss bank vault. Not only did he regain peace of mind, he also gained access to financing using the gold as collateral. This is the difference. In Switzerland, gold is not just stored, it is mobilized. Rule 13. Protection in case of bank failure. What happens if a Swiss bank fails? In many countries, your deposits, your securities, your gold, everything collapses with the bank. In Switzerland, the law is different. Custody assets are legally separated from the bank's balance sheet. If the bank goes bankrupt, creditors cannot touch your securities or your gold. They remain yours. Only cash deposits are limited, insured up to 100,000 francs. But securities, precious metals, custody assets, they are protected by law even in bankruptcy. This is why Switzerland has survived financial crises while other banking systems collapsed. Your custody assets are a fortress. Rule 14. Americans and FATCA. Many Americans believe it is impossible to open a Swiss account. FATCA, IRS, endless forms. The truth? It is possible. But only in very selected banks. These institutions accept US clients, but under strict rules. Higher minimums, usually 2 to 5 million. More documentation, more compliance checks. And sometimes quotas. A bank may accept only 50 or 100 million USD per year from American clients. With a US passport, you are welcome, but only at certain doors. I had an American couple. Their domestic bank in New York rejected their international diversification. In Zurich, after the right introduction, they were accepted, but with a minimum of 3 million. They complied. Today, they sleep better knowing that part of their wealth lies outside the US system. Rule 15. Reputation and source of wealth. Before compliance, before forms, before contracts, there is Google. The first thing a banker does is type your name. If negative headlines appear, corruption, lawsuits, scandals, the process is over. Your reputation is your passport to Switzerland. The second filter is your source of wealth. Every franc, every dollar must be documented. Employment, inheritance, business sale, investment gains. If you cannot prove it, you will be rejected. I had a client who won the lottery. He had the official documents, and that saved him. Another client came with cash-based business income, no records. He was denied. In Switzerland, your wealth must be clean and provable. We have now covered 15 rules that define Swiss banking. Rules you will never read on a website, rules your banker will never whisper in your ear. And what do they tell us? That Switzerland is not for bargain hunters, that it is not for speculators, that it is not for those who want a quick thrill or a status symbol. Switzerland is for those who think in generations, for those who want continuity when the world shakes, for those who see wealth not as a number, but as a responsibility. I have seen athletes lose fortunes, entrepreneurs waste millions, heirs destroy legacies, not because of bad markets, but because of bad decisions. And I have seen families who protected their assets, who built fortresses, who slept peacefully through every crisis because they understood the rules. Swiss banking is not magic. It is knowledge, discipline, and protection. So the question is not, can you open an account? The question is, are you ready to play by the rules? Because remember, your assets deserve more than hope. They deserve a fortress,